Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It is just after 12:01 p.m. Eastern Time. I also want to say, of course, good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones, and of course, good early morning if any of you are joining us from parts of Asia, parts of Australia, and of course, good evening to anyone joining us from parts of the UK or parts of Europe. Welcome to today's presentation, Debit Spreads versus Credit Spreads. Today we're going to do an introduction to the four vertical spreads, what are called the vertical spreads, same expiration, debits versus credits. It's a Power Options presentation. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Been with Power Options since about 2001. Been trading positions and option strategies myself for about 16 years, and of course doing a lot of education across the country and online webinars as well. Now, all this week we're going to host presentations related just to the four vertical spreads. In today's class we want to break down the structure of the four vertical spreads, the basic actions required for entering each spread, what are the goals and essentially reasonable expectations for each spread, the proper structure, alternative structure, the risks of each spread, and of course the not so obvious risks for each position as well. Now before we go any further, just want to do a brief word from our sponsor. Of course, what is Power Options? Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We support over 23 of the commonly used option strategies, including the four vertical spreads we're going to discuss today, as well as combinations of combining spreads together to create condors, butterflies, and more. Now, our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance and stock sentiment as well. Further tools to research and analyze the stock or the options in your position. And then, of course, powerful portfolio tools to help you analyze, track, and manage your open positions. We, of course, offer countless help videos, articles, and archive webinars to help investors get more familiar with the various strategies that are available to options investors, as well as, of course, how to use the tools on our site to implement those strategies as well. Now, Ernie Zarena created the Power Options tools back in 1997, essentially to trade his own personal account. But of course, everyone here at Power Options uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. All right, so before we begin, I'm just going to launch a quick poll here. And what I want to know is, are you currently trading spread positions? Vertical spreads, some of you might even be doing calendar spreads. But what I want to know is, are you currently trading spreads? Are some of you doing a lot of spreads with most of your account? You know, maybe you have 50-60% of your account allocated to spread trading. Or do you do a few spreads weekly, meaning you do a couple weekly spreads here and there, 5 days, 7 days out in time? Are you only doing maybe 1 or 2 spreads per month, or are you just learning the vertical spread positions? Okay, Ronald says he's doing credit spreads and condors. Fantastic. All right. Okay, so I'm going to leave the poll open for about another 15 seconds. If you haven't voted yet, I encourage you to do so. Okay, so Ronald does say he's doing credit spreads and condors, but he's just learning to intermediate. Very good. Okay, so you'll get some refresher today because this is an introductory course in the four vertical spreads. But later on this week, you're going to get a lot more in-depth knowledge on criteria and sentiment to look for, as well as management techniques and trigger points and more. All right, we've got a lot to cover today, so I'm going to close this poll. Let me share the results with everyone. It looks like 24% of you, well, this is almost a fourth of us, are doing credit spreads with most of your account set aside. Okay, 10% of you are doing a few spreads on a weekly basis. 38% of you do 1 or 2 spreads per month, maybe to help enhance your returns, other strategies. It's fantastic. And 29% of you are just learning spreads as well. Okay, let me go ahead and hide that, and I'll check something real quick here. For those of you that are actively, I'll do this now, but for those of you that are actively trading spreads, let me just know, what kind of time frame do you use? Are you using just weekly spreads, as short a time frame as possible? Maybe you're looking to open positions on Monday that expire on Friday. I have several power options customers I talk to that like to open positions on Thursday that expire on Friday. They're essentially doing one-day spreads on either SPX, SPY, or maybe the NDX. Do you go maybe 7 to 14 days out in time, keeping it shorter term, but at the same time, looking for a reasonable time frame and a reasonable net credit? Now, are you doing maybe standard expiration, going 30 days out in time or more on your positions? Or some of you may be actually opening spreads that are 6 months out in time. And I'll explain the benefit of that a little bit today as well. All right, so we've got over 70% of our audience voted. It's an interesting result. I did not expect this, but hey, that's why we do these webinars, and that's why we have these polls here. I'm going to go ahead and close the poll down, and we're going to jump right in here. Let me share the results, of course, with everyone. 9% of you are doing the weekly time frame as short as possible. And 30% of you are doing weeklies perhaps, but you're maybe going 7 to 14 days out in time. And 57% of you are actually doing 30-day out spreads, using the standard expiration, looking for the most time. And 4% of you, of course, are doing the 6 months out in time or more. Okay, fantastic. Let's go ahead and hide that and get right back to it, shall we? Let me make sure the view returns. Excellent. All right, so we have some experience here. We have some ones just learning. Why vertical spreads? Well, the vertical spreads give us a great opportunity to have leverage positions. You don't have to buy stock. Don't have a lot of margin. You can control the margin requirement by setting your strike price differences or the cost basis in a debit spread. You don't have to worry about owning stock or shorting stock. You have a limited monetary risk. You know the risk up front. It's dialed in, but it's only limited if you trade responsibly. What I mean by that is if you have a sure thing, you're bullish on Apple, and you look to open a bull put spread on Apple, for example, it's got a good probability, and you do 100 contracts, well, that's not really trading responsibly. That's taking on a large monetary risk. You know the risk dialed in, but you increased it by perhaps over trading. It might be better to break that apart to different structures, okay? We can be both bullish and bearish. Ronald said earlier he's intermediate on condors, so he's combining a bullish and bearish spread to create a neutral combination. Probably going to cover that later in the week, not so much today. And we can set up positions, the structure of the trade, to have a high probability of success. Well, theoretically, okay? Whether you're using delta for the short option or you're using a probability of an option expiring worthless going forward, it's easy to set up spreads that not only offer you leveraged monetary risk, but a leveraged double-digit return while still having a 75, 80, maybe 85% higher probability of success on the trade. All right? Well, let's take a look at the initial breakdown of a spread position. On our left, of course, we have the two bull spreads. This is the profit and loss chart we'd expect on a bull put credit or a bull call debit. They can be set up as parity trades of one another. In this example, we'd be selling a 94 put or 94 call. And at the same time, we'd be buying a 92 put for the bull put credit spread or 92 call. As long as the stock stays above 94 in both the bull put credit or the bull call debit, above your short strike price, you'll receive the maximum profit. If the stock falls below the bought option and a bull put credit or a bull call debit, you'll receive the maximum loss. If the stock is between your strike prices, you may have some gain, you may have some loss, but not the full loss as well. On a same stock, we could structure a different position if we were bearish. So as the stock's trading around $94, so $93.74, we could sell a 94 call or slightly in the money 94 put, and then buy the 96. And again, as long as the stock stays below both strike prices, either in a bear call credit or a bear put debit, you'll receive the maximum profit. The stock rises above the bought strike price, of course, you'll receive the maximum loss. And if the stock is between, you'd have some gain or some loss as well. Okay. Ronald asks a question, is there a reason you're choosing a $2 spread? Yes, there is. I might cover that if we have time in the end of the presentation here for this example. Our other two examples to keep things simple that we're going to look at with the individual spreads today, real-time examples from this morning for our bull put credit, bull call debit, they're actually 2.5 point spreads. But in this example of a weekly one from a previous presentation, I just like the way that these slides look, these images I took looked, there is a reason I'm taking a 2-point spread, and I'll cover that a little bit later, okay? And on Wednesday, I'm actually going to show you proof in the pudding why a 2-point spread is actually more profitable than a 1-point spread or a 50-point spread, okay? And even a 5-point spread as well, based on what you're doing. I'll elaborate more on that later, okay? But let's move on here. All right, so we just showed the graph, the graphical interpretation of the 4 spreads combined together, because when you use the same strikes and same expiration, a bull debit spread is a parity to a bull credit spread, and the same with the bearish spreads, all right? So on our credit spread, with a bull put credit spread, we're typically going to sell an at or out of the money put, a put that's below the current stock price for better probability of success. And then we're going to buy a cheaper out of the money put to receive a credit. Naturally, the risk is the difference in the strike prices. Now on a bull call debit, I'll use the same strikes. We just saw that if I'm comparing parity. So our example with the stock trading at 94, on a bull call debit, I'm selling a call that's just below or slightly below the stock price. It's in the money. Where the put is out of the money when it's below the stock price, our call that we're selling is in the money. And I'm going to buy a more expensive, deeper in the money, lower strike price call to create a debit. Okay? Now with the credit spreads, the bearish credit spread, you're selling options that are above the current stock price. So for a bear call spread, it's an out-of-the-money call. It's above the current stock price. Your hope is the stock stays below that. And you're going to buy a deeper out-of-the-money call for a lower cost to create a credit. In the bear put debit spread, you might use the same structure, but remember, the put you're selling is slightly above the stock price, meaning it's in the money, and you're buying a deeper in the money put to pay a debit. But again, if the stock stays below both strike prices, the bearish spreads will retain the full value. And on the bull spreads, if the stock stays above both strike prices, you'll make the full return. Okay? Most people we talk to, and I might run this poll earlier. I was going to run it at the end, but I think I'm going to run this poll right now. Credit spread, bull and bears, bull puts, bear calls, you receive a credit up front for the transaction. It's deposited in your account immediately. The option you're selling has the higher premium. The maximum profit achieved is when both options expire worthless. You keep the net credit. Your maximum risk is the difference in the strike prices. If the stock falls below both strike prices, you're going to have to take action in a bull put credit spread. If it rises above in the bear call, you have to take action to either close the position out or let your broker do it. And if it's above both, you're at maximum loss. Now, some brokers are different. Going back to what Ronald asked, we showed the bull put on the first graph of selling the 94 put and buying a 92. Means I have to cover the $2 difference in strike prices. Some brokers may require you to put that full amount. So if I just did one contract, I'd have to have $200 on hold in my account for the entire trade. Once I close one of the short legs or close the position, that money is free for me to use again. And if you did 10 contracts, it would be $2,000, okay? Some brokers may only require the difference in the strike prices minus the net credit, the true maximum risk. So if I did a 2-point spread and I collected 40 cents of net credit, the maximum loss is $1.60. My broker may only require me to put up $1.60. Okay? That's the true loss, by the way. That 40 cents is already deposited into my account, so even if it falls below both strike prices, I'm only going to really lose $1.60 on the entire position. Now, in a credit spread, of course, the goal is to have both options expire worthless. In the bull put credit, naturally the stock remains above both strike prices. And in the bear call credit, we want the stock to remain below both strike prices as well. Now, debit spreads is a little bit different. You pay a debit to enter the position. You're using mostly in-the-money options. Both the short option and the long option are in the money. There's no margin requirement. The debit you paid is the true risk. That could evaporate if you hit the full loss. Okay, it would go to zero in the debit spread. Okay, since the debit's been paid, you don't have to worry about having any money on hold in your account, no margin requirement. And the max return is achieved if both options are in the money at expiration. So for the bull call, the stock is above both strike prices. Again, the bear put debit, the stock remains below the short puts. All right, so let's jump in. First, I'm going to launch that quick poll. I was going to save it for later. I'm just curious right now. Of the four I just introduced, and you may have another, but what is your favorite spread? Are you more familiar or more comfortable with bull put credits? Do you like to do bull call debit spreads? Are you a fan of doing bear call credit spreads, counter market? Or, of course, do you do bear put debits? I know some of you might be using combinations. Some of you might just be based solely on market sentiment and market direction. Okay, of course, I know some of you are attending today, you might be doing other strategies. Condors, Ronald already mentioned. Some of you might be doing ratio spreads. Some of you might be doing calendar calls or calendar puts, diagonals or horizontals, something I use with a portion of my account as well. All right, ladies and gentlemen, let's take a look here. Okay, so I've had the poll open for about a minute. I do promise one thing. That is the last poll we have today. Again, I was going to do it later, but I'm just curious. I wanted to see it now. I think we've got a straight market sentiment here. That's pretty interesting. So let's go ahead and close the poll. We'll share the results with everyone. 41% of you like to do the bull put credit spreads, prefer the bull puts. And 33% of you do bull calls. Okay? And 15% do bear calls, and nobody does bear put debits. All right, I find that, oh, I'm sorry, 4%. My apologies to the 4% of you. I read the poll wrong. 4% of you are doing bear puts. Okay, all right. And 7% are doing other. All right. Let's go ahead and hide that, ladies and gentlemen. Okay, so let's take a look at the bull spreads. Not only because this is how the poll turned out, but this is how I had the presentation designed. Now, rather than present the action, the goals, and the structure of credit spreads and then look at debit spreads, I feel it's better to present it as bulls and bears. And why? Because as I mentioned before, a bull put credit spread and a bull put debit spread are parity trades of one another. There are different ways to trade each. I'm going to touch upon those a little bit today, but save that a little bit more for tomorrow's presentation. But I think it's easier to show the actions, the goals, and the outcomes of both. Of course, because today's presentation was called Debit Spreads versus Credit Spread. Is one form actually better than the other? You know, we have 41% doing bull puts, 33% doing bull call debits. So is one actually better than the other? Not necessarily. It depends on circumstance and market conditions. It depends on your goals for the trade. It also depends a lot on your account size and allocation, and it will also factor in personal brokerage costs as well. These are the factors that would determine is a debit spread greater than a credit spread. Not related to the poll, though 41% of you, the highest amount, said you're interested in bull put credits. So we're going to start with the bull put credit spread. What are the actions? Okay, we're going to sell to open a higher strike put. I mean a higher strike put in relation to the other put we're going to buy in combination with the same expiration date. But the put that we're going to sell is typically going to be below the stock price. gives you a better probability of success. Okay? In any vertical spread, the short option that you're selling is what I call the pivot. That's your focal point. That's where the management's going to come into play. That's where the trigger points for management are going to come into play, and that's where you're focusing on the probability as well. Okay? So we're going to sell to open a put that's below the current stock price, and then we're going to buy to open a lower strike put, deeper out of the money, which will have a lower cost. Is the strike difference relevant? Yes, we're going to talk about that more tomorrow. Okay? But you want to set a strike difference that matches your goals and your risk. Okay? Goals for the percentage return, but also the amount at risk you're willing to put up based on your allocation and based on your trading size. You want a bullish stock. That sounds obvious. But I'm amazed at how many people will call into Power Options or schedule a coaching session, tell me, I need help managing my bull spread. I did it on this particular stock because it had a very high premium. And I look at the stock chart 2 months leading up to it, and it is in a very bearish position. They might have been going counter to the market, thinking the stock had to rebound. But in general, for success, you want to go with the trend. When I do a bull put credit spread or a bull call debit spread personally, I use pretty much the same stock criteria I would use if I was looking to buy a stock outright, if I was going to do a covered call, a cash secured naked put or a naked put position. Okay? Anything that might involve buying stock, that's the same criteria I'll use for a bull spread. Even if you know the stock, you typically want to avoid earnings between now and expiration. The reason why? Leverage works both ways. We can set up a spread that's 5% out of the money, has an 11% return and an 80% probability of success with a bull put credit spread. Well, surprise earnings comes out and the stock drops 10%, I'm at full loss. We're going to talk about that a little bit too. Andrew commented in, he says, I use credit or debit based on relative volatility. Excellent. That's another important factor also. Okay? But this is what we start for. What are the actions? On a bull put spread, sell a put that's below the current stock price, buy a lower strike put. We want a stock that's bullish, has bullish fundamentals and technicals, and avoid earnings. Okay? What are the goals? Well, we want the stock to stay above both strike prices in the bull put credit. Both options expire worthless. We have the max return. What are the goals? To get a reasonable net credit with a reasonable probability of success. What do I mean by that? Well, in general, if I'm looking for a probability of success, probability the stock will remain above my short put strike price of 75% or more, which might equate to using a delta of, let's say, negative 0.25 or less on the short option. I can't expect to get a $3 net credit on a 5-point spread with an 80% probability, or a $1.50 net credit on a 250 spread with an 80% probability. If I'm looking for an 80% probability or higher, I'm looking at maybe making 40 cents on a 2-point risk. Okay? Maybe 50 cents on a $2.50 spread, more like 50 cents on a 5-point spread, which equates to 11.1% return. Okay? I often get customers who are using the Power Options tool and say, I want to find credit spreads that offer at least a 25% return against the risk, have a 95% probability or higher, and are only 4 days or 5 days to expiration. Hey, I'm going to find those too, and if they exist, the tools will find them. But in general, you have to have a reasonable goal structure, okay? And you want to keep the strike prices relatively close. We're going to look at this more in a minute, but a higher net credit, if I buy a cheap put using a spread that's 10 points apart, 15 or 20 points apart, so the put option I'm buying is very low cost, I'll get more of that initial net credit. But I'm only talking 10 or 50 cents more to take a risk from 5 points to 10 points. Okay, a wider spread might take on too much risk, but the reverse is true as well. Many of you trade the weekly options. We saw that already. And you might have the opportunity to trade 50-cent strike differences, which means you might get 4 cents or 3 cents. Well, I think that's too little of a net credit, even if you're trading multiple contracts, okay? There's a wide spread there, okay? Okay, Ronald says, Michael, this isn't intuitive to me. If I'm paid a credit up front, why would I also have an unrealized gain? All right, let me talk about that in a moment, Ronald. I'll make sure to get to that to you in a moment, okay? All right, so what are the costs when entering a credit spread? Well, you're doing a two-leg position. A commission is going to be paid to enter the spread. Very few brokers will charge a commission for each action, selling to open one leg, buying to open the other. Usually they'll offer a discount for entering the spread. So where your normal commission, let's say for an option, is $5.95 to sell a put and $5.95 to buy a put, instead of charging you close to $12, they might only charge you $8.95 as a spread entry. Okay? Now for a credit spread, if all goes as planned, both options expire worthless. Little to no cost for allowing the options to expire. But again, the cost underlying to Ronald's question is you'll have to have on hold in your account either the full difference in the strike prices to cover the margin requirement of a credit spread, or your broker might just charge you the difference in the strike prices minus the net credit. That's what I'm going to focus on today as far as the risk-reward analysis for our spreads. All right, let's take our current example. Current example from this morning. Alibaba Holding Group, BABA, came up in the default bull put weekly search on power options. Okay, what would be my actions for entering a bull put credit on BABA if I'm neutral to bullish? Well, I want to find something that matches the probability, and I want a reasonable net credit. Okay, so here's a position where I could sell to open the September 1st expiration, 10 days away, 165 put. It's below the current stock price, and we get $1.13 in premium. At the same time, I'm going to buy to open, same expiration, 1st of September, lower strike put. In this example, we use the 162.50. And we're going to pay 72 cents per contract. So my total net credit received up front, deposited in my account, is 41 cents per contract. If I did one contract, it'd be $41. If we did 10 contracts, it'd be $410. But now the maximum risk, the most I could lose, if Alibaba falls below 162.5, September 1st expiration, is $2.09. The difference in the strike price is $2.50 minus the net credit I received. Okay? The percent return, I'm looking to deposit, I'd have to have on hold in my account $2.09 per contract. Again, for one contract, it'd be $209. For 10 contracts, it'd be $2,090 on hold in my account until I close the position or hit expiration, looking to make $41 versus $209 for one contract, or $410 for $2,090. So the return is 19.6% if everything works out as I wanted. Now the theoretical probability above that Alibaba will remain above 165 on September 1st expiration, 10 days away, is 78.7%. All right. Here is the profit and loss chart for the BABA position. This is not a recommendation or suggestion directly. It did come up on our default bull put weekly search that we have, but this here is this as well. Okay. I'll get to this in a moment. Now, Ronald says it's not intuitive to him originally that if I'm paid a credit, why would I also have an unrealized gain? So remember, our net credit is 41 cents that we took in when we opened this position. That's deposited into my account, and I keep that as we go through expiration. But the minute you open the trade, Ronald, the 165 put that you sold for around, was it 170, I'm sorry, 130 or so, might be priced at about 134 if I went to buy to close it. And the 162.5, that you paid 75 cents for, or 72 cents for, might have a premium of 73 cents. This is why the 41 cents to me is not a realized gain. It's an unrealized gain when you open the position, because if you close it, you're going to lose money to slippage if you closed it right away. The max profit, the full 41 cents, is realized at expiration if the stock is above 165. Yes, it was deposited into your account, but until you go through to 1st September expiration, if you went to close it, the spread any time before that, both options would still have some time value, even if it's above the price, so you haven't realized the full 41 cents until the position is closed, it expires, or you manage or adjust the position. That's my thoughts on it. Yes, your true risk is only the it's $2.09 that we mentioned as well. Okay, and Andre says, can you explain the rationale behind the strike selections? Well, this presentation is more introductory on the structure, okay? Why was the rationale there? Because using the default criteria I look for, again, the Power Options weekly search is looking for about 8 to 17 days out in time, looking at the 2-week time frame. I do want to be out of the money. I want a probability of greater than 75%, and I don't want this risk to be too wide. Okay? I could do the 165, 160 and get a higher net credit. I keep more of that original premium that we sold on the 165 put, Andre. That's true. But looking at it monetarily, okay, we are taking in roughly, what was our net credit there? I'm sorry, 41 cents on a 250 spread. Okay? If I opened it up to do the 160, I might only pay 30 or 40 cents for this position. So I might get a net credit of 70 cents for a risk of 430. Okay? Could I use dollar strike differences? Yes. We're going to talk about that more tomorrow, where actually $2 and $2.50 spreads we found are more profitable in historical testing. Okay? Even above the 50-cent strike differences. So in general, I look for a $2 spread or more. Here I took the 250 just as a rough example. But yes, the put option I sold, I want it to be below the stock price. I want that good probability of greater than 75% or so as well. We'll also talk about that in a moment. And I don't want the risk to be too wide. All right, but let's move on. Remember, an important note, and this is very important, entering a spread position does not change the rights and obligations of the individual options that you entered. You sold to open a put option. We sold the 165 strike in this example. We bought the 162.50, which does mean we can end up being long stock. That is a potential outcome of a bull spread, is that you may end up buying stock. We sold a put and we bought a put to create leverage, which does give us the right to force someone to buy our shares. But as we approach expiration, if the stock is between the strike prices and we don't take action, what happens? I sold the 165, I bought the 162.50. The 165 that I sold is still an obligation, just like a cash secured naked put, where I might be able, or I might be forced, I should say, to buy shares of stock at that price. Rather than using a cash secured naked put, where I'd have to put up the full 165 for contract, we used leverage. I also used leverage in a spread because we didn't want to own stock as well. So if BABA is trading at 164 on September 1st expiration, okay, what happens? The stock is below my sold put. I have an obligation to buy shares of stock at 165. If I ignore it, I don't take action, I don't do anything. Market closes on September 1st, 4 p.m. I didn't do any adjustments on this position. My broker is going to have to assign me shares of stock at 165. Now, I'm not at the full loss, remember, right now. In theory, if I sold to close the stock at 164, or if you're assigned early, if the stock's between the strike prices and now your put's in the money, I could sell to close at a market at 164. I'd take a $1 loss. We keep the 41 cents Ronald mentioned. That's still in our account. So our loss there would be 59 cents, not the full 209. But why would I end up being long shares of stock? Didn't I buy the 162.5 put? Well, remember, if the stock's between the strike prices, your 162.5 is still out of the money. That expires worthless. No broker would force you or exercise the 162.5 put if the market price is at 164. That being said, there are some caveats where if you don't have the full margin in your account, you let this happen where the stock fell below the short put, and you were going to be forced to buy shares of stock at 165, and you don't have near the margin in your account to cover purchasing 100 shares at 165 or 1,000 shares of Alibaba at 165, your broker may choose to exercise that 162.5 put even though it's out of the money, where you take more of a loss than the market price because you did not have the margin requirement in the position. Okay, that's a possibility. Okay, but again, if it's between the strikes, you're not at maximum loss. We don't want to let this happen. We would typically look to adjust the position. That's what we're going to really cover on Thursday, is the management and the trigger points as well. But it's key to remember, just because you're in a spread, you still have the same obligations that you would by selling to open a put option, which means you may be forced to buy shares of stock if the stock's trading below it. You did buy a put, which gives you the right to sell your shares of stock or force someone to buy it. That creates the margin and the benefit of the leveraged spread trade. But it is a potential outcome. Pause for a moment. Amnon asks, what tells you the probability the spread will be out of the money in expiration? Well, of course, in power options, we have that in the system. It's a common equation that's used by options traders, talked about in McMillan's book. He's used it for years with the probability equation. It's essentially looking at the past 52-week trading range of the stock, taking one standard deviation of those values to apply a bell curve, based on other factors that were mentioned earlier, such as volatility or implied volatility of the options. It creates a value. The theoretical probability above on power options we're showing at. There's other probability equations that are called ever probabilities. Okay, the probability the stock will at any time between now and expiration be above or below the strike price. It's not exactly equal to delta. In other words, in this position, we saw a 78.7% theoretical probability the stock, Alibaba, would be above 165 at September 1st. Does that mean that the short option delta is going to be 0.213? Not necessarily. It might be 0.25. It might be 0.20. It's subtly different. It's not directly related, but it is close. Okay? You can use delta when getting into the positions. I know there are services out there that teach that your short option in a spread in a bull put credit spread, I should say, excuse me, should not have a delta of greater than 0.2 or greater than 0.3, depending on which service you're looking at. We use probability, and we have that calculation done on power options looking for the probability of success that the stock will be above or below any strike price at the expiration. Okay? All right. So, in a nutshell, that's the bull put. Credits received up front. Do have to close it out. I'm sorry, I don't consider it a realized gain, as Ronald mentioned, because you won't get that full 41-cent profit until you hit expiration and both options expire worthless. Okay? If you close or manage it ahead of time, you'll have to pay more in and you won't realize the full 41 cents, even though it was deposited in your account. Okay? Oh, okay, yeah, so you could do that, Amon. It says, thank you. So accrued formula would be 1 minus delta or 1 plus delta, depending if you're looking bullish or bearish. Yes, you could do that. Okay, you could absolutely do that. That would be a crude way of looking at it. I can tell you the probability equations on power options factor in more of the near-term implied volatility, the SIV values, whereas the delta does not do that directly. It looks at a volatility, but more of the stock volatility as opposed to the implied volatility of the options if there's an increase or decrease based on a known event. Okay? All right, so that's our bull put credits. Let's talk about the debit spreads. Similar structure with strike prices, but a different outcome, same goals. But here's what we would do. Again, to enter a bull call debit spread, I'm going to sell to open a higher strike call that's at or below the current stock price. Again, the bull call debit, both options usually start being in the money, below the current stock price. The bull puts are also both options typically below the current stock price, but that's out of the money. This is again the pivot. And then I'm going to buy to open a lower strike call, which is deeper in the money and will have a higher cost. This creates a debit. How much debit do you want to pay? Well, it's the same as setting the strike price difference. How much margin do you want to pay for your bear call credit based on the return you're receiving versus the bull call debit as well. Same situation. I want a bullish stock. I want to avoid earnings or the unexpected event. What are the goals? The exact same as the bull put credit. That the stock's going to stay above both strike prices and both call options in my debit spread remain in the money. I'm going to close the spread and I'm going to get the difference back. This relates directly to Andrew's question just popped in. Do you let your spreads go to expiration or do you get out a couple of days early? All right, we'll talk about this more on Thursday, but briefly, in general, I follow the 80-20 rule. If I'm in a bull put credit spread and I've got an 80% profit with only 20% of the time remaining to expiration, I'll close out the spread. If I'm 2 days away or 3 days away and I've realized 80 to 85% of what I expected to make, I might close it early on a credit spread. On the debit spread, I like to hold it as close to expiration as possible. Why? Well, we're going to talk about that in just a moment. It's the requirement of the debit spread. But again, Andrew, if I opened a 14 or 15 day out trade or even a 30 day out trade and there was a surprise bullish movement on the stock and I'm in a bull call debit and I can close that bull call debit spread a week early or 2 weeks early and get 85 to 90% or 80% or more, I should say, to keep it even, the 80-20 rule, I'll go ahead and close it out. Why keep it open for a change or, a sudden pullback? Now that being said, Andrew, that's when I'm looking at the 14-day out, 2-week out options, or maybe a 1-month out option. If I'm using a weekly spread, I opened a position on Monday and it expires Friday, what do I know? I still want a good probability, but my credit might only be 15, 20 cents. I did 5 or 10 contracts, it doesn't matter. If I'm doing a shorter term spread, or some of the traders I mentioned, I know on power options who use the 1-day out spread, well, if all things go the way I want, I'm holding it as close to expiration as possible to get the maximum. Because if you're doing shorter term, really short term, I'd say it, almost every penny counts. Andre, I'm sorry, I might get to that. My goal here is to cover the full setup of the 4. If we have time, we'll look at power options, but that's going to be done tomorrow, in tomorrow's presentation more than today. Okay? All right. So again, reasonable return with a reasonable probability of success. Keep the strike differences relatively close. I'm sorry, I knew I was going to copy and paste errantly. A higher net debit with a wider strike price might not be the best trade, whereas a 1-point spread with a lower debit might not be the best trade. Okay? You want to sort of be in the middle there. All right, so what are the costs? This is where it comes into play. Okay? All right, your commission is going to be paid to enter the spread, just as we saw with the bull put credit. If all goes as planned, both options stay in the money. Now here's the tricky part. In order to close out the bull call spread, the debit spread for the full profit, I either have to take action myself, close to expiration as I mentioned, so all time value decays and I'm closer to the maximum difference in strike prices that I get back. Okay? I have to actively close it, meaning I have to buy to close the call that I sold and sell to close the call that I bought, or liquidate the spread, or leave it open until the market closes, and now I'll have an in-the-money call and a deeper in-the-money call and essentially my broker will exercise and assign the legs. That means that to get the full profit on a debit spread, you're going to have to pay additional commissions. Okay, so why would anyone do a credit over or a debit over a credit? Well, it was already mentioned. It was mentioned earlier. Andre, I believe, said that it looks at the volatility comparison between the two. There are some stocks where the call volatility might be higher than the put volatility, or vice versa. Okay? You don't have to put up any margin with a debit spread, which is good. What you paid into the spread is what you could lose. There's no other margin required or money on hold in your account that you have to pay attention to. You've essentially already taken it out and it's deposited into the market. Okay, so no margin requirement. The risk is the debit that you paid. Now, we could set up the bull call debit as a parity trade to the bull put credit we just looked at on Alibaba. Same strikes. I could sell to open the September 1st 165 call for $7.65. This option is $6.39 in the money. So a lot of that premium is the intrinsic value, of course. But to complete the spread, I'm going to buy the 162.5 call for $9.73. So my total debit is $208. That's what I've paid out of my account, $208 for one contract, $2,080 if I did 10 contracts. This is the maximum risk on the position, the debit that we paid. What's the maximum profit? Well, if all goes as planned, remember, I'm going to close out these two legs, either by buying to close the short call, the 165, and selling to close the long call, 162.5, and I'll get close to 250 back. But I paid 208, so I'm looking at a 42-cent max profit on an investment of 208, which is a 20.2% return on investment. The probability is the same. Same stock. Same likelihood that the stock will be above 165 as our bull put credit spread. That didn't change. Well, it'll change as the market goes up and down over the next several days, but it's not going to change at the time of entry. So as a parity trade, the bull call debit, definition of parity, has a similar risk-reward profile, but we paid a debit of 208 to get into the position. I'm sorry, that went a little wide there on me. So the max return is 42 cents, or 20.2% for our 10-day trade. If the stock stays above 165 and I do nothing at expiration, what happens? I have an obligation to deliver shares of stock I don't own at 165, and I purchase the right to buy shares of stock at 162.50. So if I do nothing, hold it through Friday, September 1st expiration, stock's above 165. Over the weekend, my broker's essentially going to buy shares of stock for me at 162.50, sell them at 165, and I get the full 250 back. Again, we paid 208, so I get 42 cents or 20.2%. Andre mentions that the price of the options can fluctuate wildly in the last couple days. Yeah, depending on where the stock is. If I'm either in a bull put or a bull call debit. In this case, if BABA stayed at 171.82, both of these would be pretty close to zero. What Andre's talking about, what if the stock was trading right around 166 or 167, I might have a bid of 5 cents on the 165 put and an ask of 25. On the call, with the stock at 167, let's say, this short call might have a bid of $2 or $1.95 if they're being really cheap, and an ask of $2.40. Okay? That's a wide range, isn't it? To try to close the position. Because if I got $2.20, it means I'm paying 20 cents of time value back into the position. And if I got just intrinsic value for my deeper in the money call, I'm taking away from this potential maximum profit. I'm not getting $2.50 back, I'm only getting $2.30. Okay, so Andre brings up a decent point that in the last few days, if the stock's within maybe 1.5 or 1% of your strike prices, you might not get the best price. You might see wild fluctuations going up and down as the market makers are trying to get you to pay more, or the electronic market makers are trying to get you to pay more, which could really hurt the spread. So in that case, Andre, I'll say this: if I'm in a bull call debit, 2 days to expiration, the stock's at 167. If I'm not getting at least 60 to 70% of that 42 cents profit I was hoping to make on the position, I'm not going to close early. I'm going to take my chances that the stock stays above 165 on the debit spread so I can get closer to that full 250 difference in strike prices on the position. Okay? All right. So, same risk-reward profile. What happens if the stock falls below 162.5 and our bull called debit? Well, both your calls are out of the money. They expire worthless. You get zero value back. You lose the full 208 debit that you paid into the position. Okay? But again, it's a parity trade when used at the same strike prices. Here we just saw two positions with the same goals. We wanted the stock to stay above 165 to make the maximum profit on each. Both at the time of entry had a 78.7% probability of full success. Now the bull put credit took in 19.6% potential return at expiration, but we saw the debit might get us 20.2%. Here in this situation, the debit spread might actually be better. I'm getting a little bit more bang for my buck, 0.6% more for a 10-day trade. Okay? But you have to factor in the additional cost. Bull put credit, maximum return of 41 cents, and the bull call debit had a maximum return of 42. The credit, you receive that 41 cents up front. The debit, if you get closed out at full intrinsic value at 250, you paid 208, you get 42 cents back. Okay, so 1 cent more. And a leverage trade, that works out to be 0.6% higher return. However, remember, in the bull put credit spread, if the stock's above 165 on September 1st, both puts expire worthless. Some brokers may charge you a very small fee, minimal, 3 cents. Some charge you none. But in the debit spread, the bull call debit spread, to get the maximum return, one of two things has to happen. I either leave it alone to expiration, and my broker will buy shares of stock for me at 162.50, sell them at 165, and I get the 250 back. But that might be as much as 2 stock commissions depending on how my broker does it. As Andre mentioned, in either case, if I close the bull put a day or so or 2 days early, or the bull call, I'm going to have to pay the commissions to close it. So at that point, the comparison is irrelevant. We're talking about if you want to hold it to expiration to get the maximum profit, you have to take additional action, or right before expiration, you have to go into your broker, sell to buy to close the 165 call, sell to close the 162.5, or liquidate the spread for 2 option commissions, or if your broker allows you to liquidate the entire spread, just that lower spread as well, that lower commission. But it does cost an additional commission. Why is it important? If you're trading with a smaller account and only doing 2 or 3 contracts, the BABA parity trade comparison using the debit spread would only give you $3 more. If your commission to close a debit spread's above $2, the credit spread's better. Okay? But let's say that you did 10 contracts on the position. Well, having 1 cent more would give you $10 extra, and if it's only $2 to close the spread, you're still getting $8 more than you'd get potentially on the bull put credit spread. Okay, so you have to take this into account. I always look at the parity trade when entering a position. Even if I've decided I'm bullish, I will do what 41% of you do. I'm bullish on a stock, or I'm using power options to find positions. I start with the bull put credit. But before I enter the trade, I'll look at the parity trade of the bull call debit. And if the extra return is high enough, with midpoint prices, potentially, if I get in at midpoint, the potential return is higher, then there we go. I'm going to go with the debit spread. As long as the number of contracts I'm using don't kill the commission and the value of seeing a debit spread. A lot of times, though, you'll see the credit spread with a higher return than a debit spread. It does depend, as I talked about in an earlier slide, circumstances and the market conditions. All right? Now, a little bit different, but keep in mind that the outcome of a bull call debit spread, a potential outcome of the bull call debit spread, is you still might end up owning shares of stock. We sold open a call, which means we have an obligation to deliver shares of stock if the stock's above it. Well, I don't care about that because that means it's above my long call as well, which I'd use to buy stock at a lower price. I bought the call to create leverage, or I sold the call to create leverage, however you want to look at it. And the call gives me the right to buy stock at a lower price, okay? But if the stock's between the strike prices as before and I don't take action before expiration, again, the stock's at 164, in my bull call debit, what happens? Well, stock's below the sold call. It expires worthless. I don't have to do anything. But if I don't do an adjustment, I am in the money long call at 162.5. I did not sell to close it before expiration, so my broker is going to assume that I wanted to exercise that call and buy shares of stock at 162.50. Now again, on Monday, if the stock still remains at 164, I can sell to close the shares. I get $1.50 back. Okay, but remember my debit was 208, so I'm still just loss. Not the maximum loss, but I would still take a loss. But a potential outcome is that I could be long shares of stock. Now, what is the subtle difference between a credit and debit spread in this scenario? We're talking about at expiration, but at any time the stock falls below your short option in a bull put credit spread, you can be assigned early. Okay? Doesn't happen that often. Usually an event would have to trigger it. Let's say a dividend is coming up or a known event, earnings or something along those lines is coming up. But remember, if the stock falls below the short put, you can be assigned at any time. Now you'd say, well, that's the same problem with doing an in-the-money bull call debit. When we sold a 165 call with the stock at 171, you'd say, oh, well, you can be assigned any time on the short call when you open the position. If I'm assigned tomorrow, that's great. I can exercise the 162.50 and have the max return in one day. Okay, so I'm not worried about that. But remember the outcome. If the stock falls below the short put, even if you're 5 or 6 days to expiration, you can be assigned early at any time. And with the put, the 162.5 put, your broker's not going to exercise this automatically for you. If the market's offering 164, your broker's not going to cheat you and get you out at 162.50. They're going to put the responsibility on you. If you're assigned early on the bull put and end up buying shares of stock at 165, they're going to put the responsibility on you to sell to close those shares, to have the margin to maybe cover those shares. They won't automatically exercise the 162.5 put if the market's offering 164. That would not be fair. Okay? They won't do that. However, if you don't have the margin to cover, let's say you did 100 contracts, you don't have near the capital to cover it, again, they might assign you early at the 162.5 put, even though the market's at 164. But remember, the outcome of any bullish spread, bull call debit, bull put credit, is that you could end up being long shares of stock if you don't manage it prior to expiration and the stock's between the strike prices. Okay? And as always we talked about before, and most of you are already doing it, we talk about the shorter term options will increase your annualized return. And most of you are already doing that. You know, we had 9% of you doing weeklies, 30%, and 57% of you are doing 30 days. Only 4% of you are going 6 months out in time. So you want to keep any of those spreads, bull call debit or bull call debit or bull put credit, under 30 days out in time. Now, what about improved risk reward? Touching a little bit on the difference in strike prices. Remember that the positions we saw for Alibaba, both the bull call debit and the bull put credit, had a probability above of 78.7%. But in each one, we were looking at about a 42 cent maximum return on a debit of 208 or 209. It's a 5-to-1 risk-reward ratio. Well, can you get a better risk-reward ratio? Here we're looking at a screenshot of our midpoint spread chain tool for Alibaba, right around 171.81 this morning. Okay? Highlighted is the position that we were viewing. Okay, it changed a little bit as prices moved. The probability went up to 80.3%. But still, 36 cents on a 2.5 point spread. Okay, and 214 debit on the 250 spread, so about the exact same number at this point. Well, the stock's at 171. I can get a better risk-reward ratio. I could sell the 172.50 put or call and buy the 170. Again, it's a 2.5 point spread. Here's the 172, and here's the 170. Remember, the stock's trading right at 171, close to 172, but it's between the strike prices. But see here, the bull put credit gives me a net credit of 112 on a 250 risk. That's very close to a 2-to-1 risk-reward ratio, an 80% potential return, but only a 46% theoretical chance the stock would be above 172.50 and I'd make the max return. Is your risk less? Of course. So 112 over 250, we're looking at a maximum risk of only $1.38. Okay, so our risk-reward ratio is $1.38 to make 112. But this takes only a 40%, 46% probability of success. Okay, again, here's the range I look for in my credit spreads. And I talked earlier about accepting a reasonable risk-reward ratio and a reasonable return to probability. If I'm looking in the 75 to 80% percentile or probability range, I know my risk is going to be close to 8-to-1 or 7-to-1. If I go to 90%, I'm probably looking at a 10-to-1 risk-reward ratio. How do you get a better risk-reward ratio? Well, you got to take the chance of lowering the probability to get the better net credit in the same strike comparison. Okay? Now the 5 points would give me, doing a 5-point spread, if I did the 170, 165 spread, let's look at that. We'd get 238 and pay 98 cents. Okay, so I'm taking from this to here. That would be the 170, 165 spread. So we'd get a net credit of $1.40, but now we're risking 5. All right, so we're still around that 4-to-1, 5-to-1 risk-reward ratio, or you could say 3 realistically. I'm sorry, 360. So it's really a 2-to-1, almost a 3-to-1 risk-reward ratio with a 58.8% probability. So when you widen the strikes, you do get a higher net credit, but the monetary amount at risk goes up more percentage-wise than the net credit you're receiving. Okay? So that's what we want to talk about with the strike. We'll elaborate more on that tomorrow. Okay? Now the bullish spreads, the criteria, we're going to cover more tomorrow real quick. Look for stocks with a bullish criteria, good fundamentals and in an uptrend. Look for a shorter time frame. All of you, 96% of you are doing that. That's great. 30% or less. Standard weekly expiration. But keep a reasonable risk reward. We'll focus on that tomorrow too. Good range, out of the money and in the money. I prefer to avoid wide spreads. Shorter time frame does mean a lower net credit, but a higher annualized return, assuming all things go as you want. Avoid earnings and avoid known events coming up that can cause the stock to fluctuate wildly. I already showed you that a lot of the spreads you might look for with an 80 or 85% probability might have that 7-to-1 or 8-to-1 risk-reward ratio. Why enter a position that has earnings coming up between now and expiration where a surprise could cause you to take the maximum loss on the spread, wiping out 8 or 10 previous successful positions? It's not a good idea. Okay? All right, so the bearish spreads. Using leverage, taking advantage of a bearish market without the exposure of shorting the stock or a naked call position. Again, we're going to sell options that are above the current stock price, whether I'm doing a bear call or a bear put debit, and then we're going to buy a higher strike option. Full profit is when the stock is below both strike prices. Max loss, stock is above both strike prices and as before if it's in between. What is the action of a bear call credit spread? I'm going to sell to open a lower strike call. Okay, what do I mean by lower? Lower in comparison to the other call that I'm buying, not lower than the strike price. I want that call to be above the current stock price so it's out of the money. And again, the short option is my pivot. That's the one I'm focusing on. I buy to open a higher strike call. It's deeper out of the money. And I'm going to set a strike difference to match the risk. You want a bearish stock that's in a downtrend. You want to avoid earnings or unexpected. Goal's pretty simple. The stock will stay below both strike prices and expires worthless. Keep the reasonable credit, same as you would with the bull puts or the bull call debits. Same with the strike prices. Too small of a strike price, too little reward. 50-cent strike differences, making 3 or 5 cents, maybe that's too little reward. $1 strike difference making 7, 8, or 10 cents, maybe too little. 2-point spread, 20 cents or 30 cents, looking a little bit better. Okay? Credit spread, bear call credit, same as the bull put. Commission to enter the spread, might be one for each depending on your broker. Likely they offer a discount for entering the spread position as a whole. Don't have to really pay any extra fees if the options expire worthless as you expected, but it has to be managed. Of course, you're going to have to pay commissions to sell. Same as the bull put, to cover the trade, we've got to put in either the full difference in the strike prices or the max risk, strike difference minus the net credit. All right. Current example, different stock, came up in the bear call credit weekly search on Power Options this morning. Chipotle Mexican Grill, currently trading at 306.50. We could sell to open the 1st of September 320 call for 205. At the same time, buy to open the September 322.50, higher strike call, lower premium, $1.58. Good net credit of 47 cents for a 10-day trade with a maximum risk, a difference in strike prices of $2.50, but a true maximum risk of only $2.03. The return for the margin requirement of 203 on hold, potential 47-cent max profit, 23.2% of the investment. And again, 79.4% probability below 320, which is what we want. Here's our bear call credit spread. Selling the 320 call, buying the 322.50. If all goes as planned, stock stays below 320, both calls expire worthless, margin is freed up, you keep the net credit. Stock gaps up to 325, what happens? We hit the maximum risk on the position. Okay? Remember the rights and obligations. We entered a position here that obligates us to deliver shares of stock that we don't own. It's like a covered call. We sold a call, but we don't own the stock here. We did buy a higher strike call to give us the leverage. So we only have to cover the margin, but if the stock gap's above both strike prices, I may be forced to buy shares of stock at, oops, sorry folks. Sorry, I may be forced to buy shares of stock at 322.50, and then my broker would sell them at 320. I take the 250 loss, but the 47-cent net credit was already deposited. Andrew asks, is this being recorded? Of course. We're recording all of our 4 presentations this week, and they will be available. We'll let everyone know when our presentations are archived. This one will be available in the archives at around 5 p.m. Eastern Time. All right. So with that in mind, remember your rights and obligations. I did sell a call on the bear call credit, which obligates me to deliver shares of stock at that price, in this case at $320. But I don't own the stock. I own a call that allows me to sell those shares of stock at 322.50. But again, if the stock is between the strike prices and I don't take proper action through expiration, instead of being long stock in the bear spreads, you may end up being short shares of stock. Okay? So we go into Friday expiration. The stock was at 319 on September 1st. It opened. It looked like it was pretty good. We were still going to hopefully expire worthless, but the stock started to creep up. And then in the last half hour of the day, the stock moved from 319.85 up to 321 or 321.10. 4 p.m., we didn't close the position. Stock's at 321. Stock is above your sold call. You have an obligation to deliver shares of stock you don't own. The 322.5 call, if the stock's at 321, between the strike prices, anywhere between the strike prices, that still expires worthless. Your broker, again, won't necessarily exercise that 322.50 call for you if the market's offering 321, even though it's after hours. Okay? So what happens? Well, you have an obligation to deliver stock you don't own. The outcome here, just like a naked call, you're going to end up being short shares of stock on Monday morning. You'll be short shares of stock of CMG at 320. Yes, you still have the net credit in hand, the 47 cents. And if the stock opens at 321 on Monday, you could buy to close the stock at 321. take a 1-point loss, but you still have the 47 cents, your loss would only be 53 cents. This is dangerous. And going back to what Andre commented on earlier, and Andrew mentioned as well, that's why it's a benefit to close the positions early. You don't want to take the risk necessarily of being short or long shares of stock over the weekend. Why? I held this position open, the stock's at 321. I didn't close my short call. I end up being short shares of stock at 321, and over the weekend, on Monday, CMG opens at 338. Now my position that could only have lost $2.03 originally is at about an 18-point loss. I've got to pay $338 to close my short stock position. Okay, so it's not worth taking the risk of being between the strike prices, being long or short stock. Let's be honest, we're trading spreads because we don't want to mess around with being long or short stocks. But remember, that is a potential outcome. And if CMG happens to pay a dividend, and let's say the ex-dividend date is on August 30th, for example, and by August 29th, next Tuesday, August 29th, CMG is up at 321. It's above my short call. Remember, I can be assigned at any time. If the ex-dividend date is coming out tomorrow, I might be assigned early and find myself short shares of stock at 321 going into the dividend. Would my broker exercise the 322.50? Not necessarily, because it's not at expiration. They're going to put the onus on me to do that, okay, to cover that short if it's early assignment. But why is that an additional risk? Stock's at 321, August 29th, ex-dividend dates on August 30th. This isn't true, I'm just saying as an example, is on August 30th. I get assigned and I'm short shares of stock at 320. I didn't get a chance to cover it before the open. Now I'm on record of being short X amount of shares of stock on ex-dividend date. Now I have to pay a dividend as well. They're just rubbing it in. This did happen to one of my customers in a calendar spread, actually, where the short call was slightly in the money on ex-dividend date 2 days before expiration. He found out he was short shares of stock at the close because the call was exercised. They didn't exercise his long call because it expires 3 months away. It wasn't at expiration. And that next morning, he ended up paying the dividend on 2,000 shares of stock that he ended up being short on. Okay, so that's always a risk inherent. Now, the bear put debit, we are starting off with an in-the-money put. Why is it okay to start off with an in-the-money put where we don't want that to happen in a bear call or the bull put credit? Because remember, that option that I'm buying in the debit is deeper in the money. In the case of the bear put debit, I can sell the slightly in the money 320 put for 15.10 and buy the deeper in the money 322.50 put at 17.10. So if I do get assigned early on this in the money 320 put, my long put's still in the money, I can exercise that immediately and get the 250 back, and I'm at max profit. Again, in this scenario, using the midpoints, we see a total debit that I would pay. Sorry about that. The total net debit is $2, which means the max profit, if I get my $250 back on the debit spread, make 50 cents, which is a 25% return. And again, it still has the same probability of 79.4% below 320. Same profit and loss, but remember, the rights and obligations of the position. We want the stock to stay below 320. What happens in that scenario? If it's at expiration, I have an obligation. Both puts are in the money. I have an obligation to buy shares of Chipotle at 320, and I have the right to force someone to buy my shares at 322.50. My broker closes this out. I buy shares at 320, immediately sell them at 322.50. I get the 250 back, minus the additional commissions, minus the net debit, and that's the return. Okay, so we paid about $2 to get in. We get 50 cents back. Okay, so that's the 25% return on the parity trade here on Chipotle for the bear put debit spread. On this one, what happens if the stock goes above both strike prices at expiration? I take no action. Nothing. Both puts expire worthless. We lose the $2 net debit. No, I shouldn't put it there. We'll lose it over here. Okay. I lose the full $2. Nothing happens. These expire. Maybe we could sell them prior to expiration for 2 cents and 1 cent and get 1 cent back, but in general, that's the maximum loss. Again, once more, rights and obligations. What's the risk if it's between the strike price at expiration? I don't take action. Stock's trading at 321. I wanted both puts to remain in the money. Now my short put, the 320, is out of the money and it expires worthless. I'm holding a 322.50 put that is $1.50 in the money. So what happens? Short put expires. My broker would now assume, since I didn't actively close it before the close on September 1st, that I wanted to exercise my put. What does that mean? It means I'm forcing someone to buy shares of stock for me at 322.50. But I don't own the stock. So I have to borrow the shares, essentially from my broker. On Monday, I'm going to be short shares of stock at 322.50. Now, no one can force you to exercise early. Okay? You have control of this. You can only be assigned early on your short options. You can't be exercised early on your long options unless your broker needs to do that to cover the margin requirement. Okay? They might actually just close it out automatically. What do I mean? They might just close it at 321 in this situation rather than forcing you to short at 322.50. And you want to check with them. Of course, remember, if you end up being short shares of stock that you're borrowing from your broker because you exercised a put or got assigned early on a call if it was between the strike prices, you may also have to pay rolling margin fees depending on your brokers. That actually adds to the loss or adds to the cost basis on the position. Okay, so it's still a potential outcome. Remember the rights and obligations. You can only be, I don't want to say that. You can be assigned early at any time, but in the case of the debit spreads, it's okay to be assigned early because then you can immediately exercise your long option and you've hit the full profit early. If you're assigned early on the credit spreads, that might require more movement, which is usually in general why we don't want to let the short put in a bull put credit spread or the short call in the bear call credit spread go in the money. That would be a trigger point to manage or adjust the position, which we'll look more in depth on at Thursday as well. Okay, same thing as before. Remember, bear call versus bull put. I'm sorry, bear call versus bear put debit. We saw here again that in this case the bear put debit was offering a slightly higher return. It was about 25% versus I think it was 21% on the position. I'm sorry, hold on. Okay, sorry about that. Yeah, the original bear call credit spread on CMG, 321, 322.50, was a 23.2% return, 47 cents off of a debit or a margin requirement of 203. 25% was the potential return on the bear put debit. So in this case, once again, it looks like the bear put debit spread would be better, but remember what your costs are for your account size and your allocation personally. If you're only trading a few contracts, that extra 3 cents or 4 cents might not make a difference because you know you have to pay the extra commissions to close it to get the maximum profit. Of course, if the spread goes against you, you're going to have to pay commissions one way or the other to close both legs as well. Okay? So always evaluate the costs first. Remember your rights and obligation in any vertical spread. You can end up, I should say, being long stock on the bull spreads, short stocks on the bear spreads. Okay? We'll cover this more tomorrow. Remember, bearish spreads look for stocks with the bearish criteria in a downtrend and showing weakness. We want to keep the shorter time frame for a better annualized return, but I do have debit spread investors who will go 6 months out and look for that lower risk reward, where on BABA, that was trading at around 171, they might actually be selling a 172.5 call for, let's say, December and buying a 170. It's an out-of-the-money bull call debit. Why? Because it's really close to a 1-to-1 risk-reward ratio, and they are bullish long-term on the stock, thinking by December it might be above 175 or 177 or 180. We'll talk about that tomorrow too. That's another approach. But in general, we get a better return, better annualized return. And with these vertical spreads with high probability, where we're looking at that 5-to-1 or 7-to-1 risk-reward ratio, remember, We want less time for the stock to be able to move against us. That's why the shorter term is also beneficial. Okay? Want to be a good range out of the money and in the money for the bear spreads. Bear calls out of the money. Bear puts in the money. Not necessarily taking on the wide spreads unless it matches your risk-reward tolerance. You do have to decide that for yourself. But I'm not a fan of taking 20, 25-point spreads on positions unless maybe I'm looking at a broad-based index like SPX or NDX, okay? Or Priceline, for example, might be beneficial. But then again, that margin requirement is moving up faster and higher percentage-wise than the net credit you're receiving by paying a lower cost. Always avoid earnings and other events. Final thoughts for the introduction to spread security selection. Make sure that the stock you're looking at matches the sentiment. Okay, fundamentals and technicals, look for bullish stocks in an uptrend for the bull call debit and the bull put credit, and vice versa with the bears. Always avoid securities with upcoming events. Do your due diligence. It's easy to try to find an earnings, to avoid earnings between now and expiration, but you also want to take a look at, is there anything about a pending patent lawsuit? FDA approvals. We'll talk about that with the positions that have too high of a volatility. And you want to remove volatile securities. Leveraged ETFs. You don't necessarily want to trade credit spreads or debit spreads on the 2 times or 3 times ultra bull or ultra bear ETFs. And remember, you can say, well, the premium is higher, the volatility is higher. Not necessarily something I want with a directional spread trade that has a 5-to-1 or 10-to-1 risk-reward ratio. Okay, the highest net credit is not necessarily the best trade. Okay. Now remember, in bull spreads, of course, I know that I've talked about this a lot, and I've maybe harped on it too much, but it is important, and you'd be surprised how many investors are getting caught with this, not realizing that in vertical spreads, that if you do a bull spread, you can end up being long stock. It's a potential outcome. And in bear spreads, you can end up being short stock. You did not cancel the rights and obligations of the individual options transaction. You may still be forced to buy shares of stock or be short shares of stock, depending on the spread and depending on where it goes. Now, Andre mentions, what about ETFs, using ETFs to remove earnings and dividend risk? Absolutely. I said leveraged ETFs. I meant the 2 and 3 times. Using credit spreads and iron condors even. In fact, the only iron condors I trade would be on a broad-based ETF or an index. I don't trade iron condors on individual stocks because of the fluctuation and the risk involved. Okay. Ronald says, Michael, is there any way that you would treat a weekly compared to a monthly? Yes, and I've already touched upon that. So what do I mean by that? We'll talk about it more tomorrow when we look at, and that webinar will be recorded as well, when we talk about the actual criteria, going a step further here into the criteria for the credit and debit spreads. Going monthly allows me to look for a higher percentage return, a deeper range out of the money. But as far as management goes, I still look for the same things. I had mentioned earlier the 80-20 rule. If I make 80% of what I expected on a bull put credit spread and have less than 20% of the time remaining, I might close out that position. Well, I'll keep that same ratio with the monthly, but that just means that if I've gone 2.5 to 3 weeks into the trade out of a 4-week trade, if I close it a week early, as opposed to closing 1 day early or 2 days early on the weekly or 2-week out spread as well. Okay, we're going to go much deeper into that tomorrow. Okay, all right. And again, appropriate time frame under 30 days to maximize annual return and to give the stock less time to move against you. Although there is a benefit of doing this sort of out-of-the-money debit spreads further out in time, 3, 4, 5, maybe even 6 months out in time, to get close to that 1-to-1 risk-reward ratio with a low debit. I wouldn't do that with a credit spread, but I may do that with a debit spread as well. Reasonable risk-reward. Don't expect to find positions with under a 10 delta or a 90% probability, which we use at Power Options, and expect a 25% return for a 5-day trade. Okay, the criteria go hand in hand. Yes, our tools will help you find that if those spreads exist, but again, you've got to have a reasonable expectation for your position. If everything could be found having a 95% probability, 25% return on a 5-day trade, well, everyone would be trading spread trades. There's a reason why not everyone trades spread trades. And of course, liquidity, you want good volume, good open interest. All right? In my opinion, I encourage you to always evaluate the parity. 41% of you are fond of doing the bull put credit spreads. That's your preferred method. There's absolutely nothing wrong with that. Don't get me wrong. But hey, check it against the parity trade. See what the bull call debit will give you. One might offer a slightly higher maximum return. Okay? The credit spread works. The options expire. No additional commissions. If the debit spread works, your options are in the money. You're going to need to close the positions. You're going to have to factor in that reasonable, not reasonable, you're going to have to factor in those extra commission costs. All right? Now, as I mentioned, this webinar will be archived part 1 of our 4-part series on spread trades this week. Okay? It'll be updated, posted, I should say, this afternoon, maybe around 5 p.m. Eastern. Tomorrow, 12 noon Eastern, how to be successful with spreads. Evaluating strike difference, criteria, stock and option criteria, what has been successful in the past, historical track records of what's worked, and amazingly, what hasn't worked that you would probably expect would work better. That's what we're looking at tomorrow. What are the criteria to use? What are the criteria to avoid? Some of the things we hinted on today. Is wider spreads better than lower spreads? Is higher implied volatility better than lower implied volatility? You know, we're going to take a look at that. Thursday at 12 noon, regardless of what probability you use and how successful you are at spread trading, and even with all my knowledge I'm going to give you tomorrow at 12 noon on how to be successful with spreads, you will find yourself needing to manage or adjust positions. Thursday at 12, we're going to discuss our preferred top 6 or 7 ways to manage credit spreads and debit spreads. With an eye to, what if you didn't have to manage that many spreads to begin with as well? And then, of course, Friday at 4:30 p.m., we're hosting our regular open discussion, open forum presentation for options traders that I typically do every Friday, but this one is going to be geared just towards question on spreads, grabbing some questions that came through from the webinars during the week, as well as questions on the fly. To register for any of the upcoming presentations, simply go to powerop.com/webinars.asp. Click the Watch Live Webinars link. You can register for any of the upcoming presentations later this week. All 4 webinars will be recorded and archived and posted and available for you to watch, but they're only going to be up for the public for a limited time. All right? Now, for those of you that asked, we're going to show more tomorrow. I mean, we're already at 1:30 Eastern Time here. So tomorrow we're going to talk about using the Power Options tools, the criteria involved. Remember, you can start a 14-day free trial with no credit card required whatsoever. Just go to powerop.com. All you need is name and email address. You can start a free 14-day trial to the Power Options tools. We're going to cover some of those tools, the searching specifically and analysis and criteria tomorrow at 12 noon. Our subscription services, we do offer an end-of-day data service at $40 per month, a 20-minute delayed service at $60 per month. And we do offer a real-time service also for our patented search and analysis tools at $120 per month. Now you see here this upgrade to historical. We do offer backtesting tools and historical data that work with the Power Options suite of tools. And the historical service, our data goes back to April of 2006. And I'm going to show you some of the results of our historical services that we offer tomorrow when we're taking a look at what's available for how to be successful at spread trades. All right, well, we covered a lot of information for a 100 level, 101 level introduction position, but hey, we needed to talk about 4 spreads today. And I felt that it's important to really cover that aspect, that remember, in any bull spread, you could end up being long shares of stock, and in any bear spread, you could end up being short shares of stock. It's a potential outcome that you have to be aware of. Hopefully I'll see you all coming up for our other presentations this week. I hope you enjoyed today's presentation. Remember, you can contact us at any time. You can send me an email to support@powerop.com, or you can also reach us during market hours. Now, I'm not going to be available for the next half hour or so, but you can reach us at toll-free, I believe, at 877-992-7971. You can also reach us if you live outside the U.S. at 302-992-7971. Remember, contact links are on the bottom of every Power Options page. Ralph came in late. Ralph, I apologize. Ralph said, is this being recorded? Yes, we did record today's presentation. We're going to go ahead and post the archive. It'll be posted around 4 or 5 o'clock Eastern Time. you can access it. You'll be able to access it on our public page. It's www.poweropt.com/webinars.asp. Okay, I'm going to send everyone that chat link there, but you also see it in the email. I'll guide you directly to where it is. This will also be posted public view on our YouTube channel, so you can just go to YouTube and search Power Options, and this will be our most recent video as well. Expect it again around 4:30, 5 p.m. Eastern Time this evening. This will be archived, and I'll include the invitations to register for our 3 more upcoming spread webinars later this week. All right, ladies and gentlemen, thank you for joining me. I hope you feel you got some useful information out of today's presentation, and I hope to see you tomorrow for how to be successful with spread trades. Take care. Have a great day. We'll see you soon.